Hey, what's up, everybody? This video is a shortened segment from a longer, about 1 hour video. Now, Seth Russ is a financial planner out of North Carolina. He works with people across all states, though. But he invited me onto his platform to talk about some tax topics. And what I did was I took that and I broke each topic down into its own video. So that's what this is. This is one of those. There's other videos about different topics from this same interview. And I've also posted the full 1 hour video, but most people don't like to sit down for an hour. So that's why I broke it up into these smaller segments. So that's what this is. Enjoy this. I'm going to let Seth do his own introduction in the video, but I hope that you enjoy and I hope this helps bring you peace of mind.
I am Seth Russ. I'm a financial planner here in North Carolina, serving people in all 50 states, though. And my goal through serving people with finances is to help them blend their faith and their money with all the stuff you do for tax on the personal side and the business side. We've got about a month and a half left in 2024. What are some things that people can do before the end of the year to lower their tax bill? This is one of the most common questions I get from W-2 employees and business owners. So what is your take?
Yeah. Yeah. My take, I got a different take than a lot of people. One of my takes is sometimes there's just not a lot you can do, like I don't like leading people along. I don't like giving them things that either one or like, I mean, they kind of already knew it and it's not really a strategy. Or I mean, certainly want to bring it up, but but yeah, it's like, okay, you're a W-2 employee. I don't really have anything for you. Now
Mhm.
then we get past that and we start getting into, okay, here's the things we can do. And again, trying to first just preface with that, right? I want to set people's expectations where they don't get, disappointed or think something really amazing is about to happen. And also telling people that, hey, your financial goals come before the taxes. I want your tax strategy to fit in your goals because I don't want you to do this tax strategy and then show up like a year later and be like, my life sucks. I hate my life because I got to keep track of all this real estate crap that I never wanted to deal with to begin with because you told me it was going to save me taxes. And it's like, okay, well, we're going to get your taxes as low as possible within your life, right? We're not going to stick something in there for tax savings that you don't want in your life. So that's kind of how I preface everything. All right. And then I start out and tell people I like the tried and true, been around forever stuff, right? Like you see it. So many people come in, they're like, I heard this idea. I want to do this, I want to do that. And they're not even putting money into their retirement account pre-tax. They haven't even thought about Roth accounts. They haven't even thought about an IRA. They haven't even thought about the HSA account. Like they haven't done it's not even low hanging fruit. It's literally laying on the ground. And they
Yep.
haven't done those things, but they want to start
Yeah.
talking about short-term rental loopholes and Augusta rule, renting their house for themselves. And it's like, hey, look, let's just pick up the stuff that they're giving us for free first. And maybe that's enough. If not, then we can start talking about this other stuff. So, in terms of businesses, all right, let's talk about kind of your basic, your most businesses, all small business, every business I have, except maybe one or two, is a cash basis taxpayer. For listeners that just, if you don't know, you don't pay tax unless you receive the cash or unless you actually, and you don't recognize expenses unless you actually pay the money out. So that gives you a lot of flexibility because now you can accelerate expenses into the current year, whether you've incurred the expense or not. If you can prepay an insurance bill that's coming up in January, pay it in December, that accelerates that expense. If you've got some equipment that you're about to buy in February or March, you can go ahead and buy that in December and accelerate those expenses. Pair that with, bonus depreciation or Section 179, and you get to write those off, right? Any other kind of anything you can accelerate. Now, the key here is you're not getting out of that tax because you were going to spend that money next year anyway. All you're doing is reducing this year's tax,
Mhm.
and you're not going to have that expense next year that you would have. But if you can't get out of taxes, deferring taxes is the next best thing, right? Time value of money. I'd rather give you $1 next year than this year so that I can keep that dollar invested in whatever. So accelerating your expenses. The thing you got to keep in mind there though is, okay, if this is actually a lower income year than what you expect next year to be, don't accelerate those expenses. Leave them for next year. Maybe even delay some expenses if you can, because you want to get them in the high income year. And I mean, if your business growing, hopefully next year is going to be a higher income year. So you just want to keep that in mind. Again, you got to balance that with the time value of money thing again. And so accelerating expenses, kind of the flip side of that, deferring revenue. Again, tax basis taxpayer, cash basis. Cash basis tax. I was like, that didn't sound right. Cash basis taxpayers can defer revenue, right? Now, I wouldn't say, okay, if you've got invoices that go out on December 1, push those to January. Probably not. But if you just did a one-off project for someone, or you've got a couple of invoices coming up towards December 20th, December 30th, just wait to send those until January. Make sure that person doesn't pay you until the next year, and you can defer revenue. Same exact thing about income. Is it higher or lower this year or next year? But it's just the flip side of the expense acceleration is deferring revenue.
Yeah.
Those are business ideas. There's a few other things there too, but all right, max out your retirement plan. Now you got the question of, do we do pre-tax or Roth? So you gotta attack that. But for your high income people, most of them are still doing the pre-tax plan. And if you can max it out at $23,000, then you're probably pretty high income. And so, let's go ahead and max that out. You can fund an IRA. If you don't do that, you can do that up till April. So you got till the tax return for that one, right? And so you could put money into an IRA. You got to be careful of the rules of whether or not it's going to be deductible and what your income limits are. But fund an IRA, fund an HSA account. Okay, you got to make sure that you qualify with the high deductible health plan. But if you do, maybe it's set up through work and you can defer money into that HSA. Or if you set it up on your own, you can just put money directly into it, kind of similar to how you would into your own IRA. But those, honestly, the HSA is the best thing out there.
Yes.
Okay, everything else can defer taxes. The IRA, I'm going to put money into it. I'm going to deduction now. It's going to grow tax free, but then I'm going to pay ordinary income tax on it and pull it out. The HSA is literally the only thing out there that is 100% tax free all the time, every time. Put the money in. It's either goes in tax free from your paycheck or you get the deduction for it. So either way, it goes in tax free, grows tax free, comes out tax free today, tomorrow, or in retirement.
Yep.
Right?
Yep.
You can do it immediately. So basically, I've done this for years where I put the money into the HSA and then immediately, turn around and spend it. And basically I just, kind of washed it through this tax-free account.
Yep.
As long as you spend it on medical, right?
Yes,
So
absolutely.
as long as you spend it on medical expenses, you can do that. Now, the better strategy, which is I just switched to it this year, is put the money into the HSA and use other money to pay for your health care expenses so that money can then stay there, grow tax-free, become another retirement account. Yeah. In retirement, I would assume most people are going to have higher, medical expenses. So you'll be able to pull that money out tax-free for medical. Worst case scenario, you pull it out for regular expenses, and it's just like a regular IRA account. You just pay the tax on it when you don't spend it on medical. So, those are the best things out there.
Yes,
get a high deductible healthcare plan, set up the HSA account.
Yeah.
Your next thing, you probably talk about this a lot, is tax loss harvesting. So you just want to make sure that you have some gains to offset with the losses. Otherwise, you get limited to that $3,000 limit. But you can go up to $3,000, offset ordinary income with $3,000 of capital loss. You also want to be careful of the wash sale rules. You don't want to recognize a loss and then accidentally buy something back that's substantially similar or the same within 30 days, or else they won't let you take the loss. But you can do the tax loss harvesting. Charitable giving. If you're itemizing, you want to make sure you're itemizing first. Want to make sure that you're going to get that benefit. But you can put money, do some charitable giving at year end. You can use donor advised funds if you don't know exactly where you want the money to go right now. If you already know that you want to go to your church, okay, give it to your church. Yeah. But maybe you're given a large amount and you don't want to dump all that on your church at once, or you don't know exactly where you want to give it, just that you do want to give it. Put it into the donor advised fund. Go ahead, get the charitable contribution for it. You can use that in terms of bunching too, right? So,
yes.
You can put 2 to 3 years worth of charitable giving into the donor advised fund and then give it over the next 2 to 3 years. But you get the charitable contribution for it now. And so that's one way to push you into itemizing, get that benefit. Yeah. Some of that might change if they don't extend the Tax Cuts and Jobs Act with a higher standard deduction in terms of, okay, maybe that goes back down and you're more likely to itemize every year. You don't necessarily need to bunch anymore. But hey, Republicans just took over everything. So I would assume that there's going to be some extension of some of that stuff. So maybe that strategy will stick around for a while. All right. I got a few more here. Any questions? I'll give you
No, go ahead. You go
ahead. All right. Your RMDs, right? You got to take RMDs. So you want to make sure you do that. But if you're, I think man, the age has bounced around from 72 to 73. I think it's at 73 right now
Mhm.
for qualified charitable distributions. So if you're 73 or older and you can do some QCDs, this is great. I mean, I've got
Yeah.
2 or 3 clients where, they might give $6,000 to $8,000 a year. They're 73 or older. They're not itemizing, so they're getting zero benefit from this $6,000. So instead, they call up their um, retirement guy, their financial planner, and they say, "Hey, give the money from my IRA directly to this
Yes.
charity." So it's got to go
Yes.
directly right from the IRA to the
Mhm.
charity. The ones that I have, usually they get a nice letter, because and you got to tell your tax guy about this because there's
Mhm.
nothing on the 1099-R that says you
Yep.
did a QCD. So if
Yep.
you don't tell me about it, I'm putting that on the tax return as taxable income because it
Yep.
shows up as a distribution. And then you've either got to give me a receipt. A lot of receipts from the ministries might say, like, thanks for your gift from your IRA. I've also seen where the financial guy gives a summary of here's what
Mhm.
came out and where it went. But that, again, they're not itemizing, so they're not going to get a benefit of this $6,000. But by doing the QCD, that money never hits their income, never goes into AGI, never goes into taxable income. 20% tax bracket on, well, there is no 20% tax bracket, but average 20% tax
Yeah.
rate on $6,000. You just save some taxes that you otherwise wouldn't have. So QCDs are great if you're old
Yes.
enough and charitably
Yep.
inclined. Energy efficient home improvements. Solar's the best one. You get 30%.
Mhm.
So again, like most things, this isn't savings. Like it's going to reduce your taxes, but you're still going to spend 40 grand on
Ye
solar, right? So look
Yes.
at this
Yeah.
as a discount. it's
Yes.
gonna it's gonna
Absolutely.
get you solar for a discounted rate. You're gonna ultimately pay less. Now, again, you got to make sure with that solar credit, you put a $40,000 system up there at 30%. What's that? 4812. That's $12,000
Something like that.
potentially
Yep.
of
Yeah.
tax savings. Yeah, usually I don't do public math, but I think that one's right. So $12,000 of potential tax savings. I got some clergy members, multiple kids, MHA, zero taxable income, solar credit of $8,000 with no tax to offset. So it just gets
Mm.
stuck there, carried
Oof.
over
Yeah.
indefinitely. They have no likelihood of using it in the next decade, probably, because it will not offset self-employment tax.
Mhm.
It's not a refundable tax credit. It can only offset income tax. So you got to make sure that you've got enough to absorb it. I've had a handful of clients who are like, all right, I'm getting an $8,000 refund. And the solar guy said that I put that money down on the loan and then my payment stays the same. And it's like, well, you're not getting that refund. You're
Yeah.
getting your normal refund, but you've got nothing to offset with this tax credit.
Yep.
And then they can't make the down payment. So then their payment bumps up because they didn't
Mhm.
make that payment on the loan that was factored into their original loan payment. So you definitely want to reach out to someone, have them look through the tax return, make sure you can actually use that tax credit.
Yep.
Other ones, they're much smaller, but you can do doors, windows, insulation,
Mhm.
get anywhere from $600 to $1,200 tax credit for those. Still not refundable, so you got to make sure you got the tax liability to use them. But things you can do there. Roth conversions.
Mhm.
Again, is it a high income year or low income year? This isn't going to save you any taxes today.
But it might in the
Now
future.
we're talking about lifetime taxes,
Yep.
which is
Yep.
another thing you want to shift people's minds on, right? Which I know you do. Is everyone's like, how can I get my tax bill down? It's like, well, Roth isn't going to do that. Roth's going to make it higher, especially if you're doing a conversion. You're going to pay tax on that,
Yep.
but let's look at lifetime taxes, not just this year. Let's have a lifetime approach to getting our total tax bill down over a course of our life. And most people, I mean, you look at where the US debt is, you look at where Social
Mhm.
Security is in terms of going bankrupt, Medicare.
Yep.
I mean, I don't know, I don't have the crystal ball, but I surely think that the people who are saying taxes are going up in the next 10 to 15 years probably are going to be right. I mean, it's probably going to
Yeah.
have to go up. We're also historically
Low.
low tax rates right
Mhm.
now in the history of our country. So good time to be putting away some tax-free money, paying the tax now, assuming that it's probably going to be higher. The other thing, of course, if you're high income, okay, maybe you're going to be in a lower tax bracket in retirement, no matter what. But things you want to talk about: backdoor Roths. If you can't put money
Yep.
directly into a Roth account, you can put money into a backdoor Roth. No income limit on conversions. Backdoor Roth is one of those dumb things where everyone knows people are doing it. They should just remove the income limit altogether, but they don't. So if you don't have an IRA, put money into the IRA, non-deductible, get the basis in it, immediately turn around, convert it to a Roth after a
Mm-hmm.
couple of days, and you're good to go. Um, if you've got IRA balances, that calculation gets a little wonky, gets a little screwed
Yep.
up. You're gonna have to pay some tax because you're gonna have to prorate what you
Yep.
pull out.
Mm-hmm.
So probably not a good idea to do it if you have significant IRA balances already. Annual gift limit. If you want to give money to kids, if you want to get money out of the estate, if you want to be able to, you've got more than you need at the moment, utilize that annual gift limit. I think it's at 18,000 right now. So you can give up to that amount to anyone, and not have to file anything, not have to report it anywhere. You give more
Yep.
than that, do a gift tax return. You're still probably not going to owe any tax on it, but you got to do the gift tax return and report it and use up part of your lifetime exclusion. So start with the annual gift limit again. That's 18,000 per person. If you're a married couple, you can split.
Yep.
Husband can give 18, spouse can give 18. Now, I haven't done a gift tax return in a while, but if you do the gift splitting, you still have to file the gift tax return.
Yep.
So just keep that in mind. You're gonna have to fee to do that, but you won't use up any of your thing, and you can get 36,000 to each kid if you do the gift splitting. 529 contributions. Again, it's one of those things where you put money into it. Most people aren't getting a deduction for it. Some states allow a deduction for it, no deduction on the federal return.
Yep.
So you may or may not get any kind of tax benefit for putting money into the 529, but grows tax free. Pull it out, use it for education of the beneficiary. Set these up for your kids to pay for college. You can also use 529s now to pay for K through 12 private
Yep.
school.
Yep.
If you're just putting it in and then taking it back out, no benefit on the federal, maybe a benefit on the state if your state allows a deduction. If it doesn't, no point in doing it.
Yep.
So those are your all right. Those are your tried and true, right? Those are the ones. That's a
Mm-hmm.
pretty long list, and if we're not checking those things off, it's like, why are we going into the next list? But we'll go into the next list. So the next list, you're going to hear these things all the time, and these things have asterisks and caveats and explanations
Mm-hmm.
far beyond this video. So I'll try to keep it short. But there are things you've heard about. There's things you're seeing about. There are things that you're seeing TikTok and YouTube and LinkedIn constantly. But they don't ever give you the details, which if you heard the details, you'd probably be like, okay, that's not for me.
Yep.
But for some people, it is, right? So you got real estate. You've got real estate, buy a rental property, write off a bunch of depreciation. Okay, there's a lot of steps in between those two things. Can that offset your high W-2? And this is for high W-2 income earners. It's people who have the money to put into real estate. They got large tax bills. They're looking for some sort of investment. So yeah, you can do that, but you still got to check a bunch of boxes. All right, you've got real estate professional. It's like 750 hours that you got to put towards that. You got to spend more than half your time doing that. So you're pretty much out if you've got a W-2 job. So that one usually goes with, okay, one spouse is working a W-2 high income job. The other spouse is stay at home. Stay at home spouse can maybe hit those requirements to make the real estate professional. What that does is if you have losses from a passive rental activity, they're no longer limited by your income or that $25,000 limit that can sometimes come into play. Check the boxes though. 750 hours, more than half your time. You got to make sure you document this stuff. Got to make sure you have it squared away. But you also have to have losses. Well, how do you get the losses? Well, the losses usually come into play with a cost segregation study. So you buy the rental property, do the cost seg study, because if you don't do the cost seg study, rental is going to be either 27 and a half years or 39 years. And you go buy a $500,000 Airbnb property, divide that by 39 years. Well, first subtract out the land value because it's not depreciable. So now maybe you're left with 400,000 of building, divide that by 39 years, you're not really saving a whole lot. Okay, that's a great depreciation deduction, but it's not the big fancy one people were talking about, right? So you do the cost seg study, they break down, okay, this was for cabinets, this was for other items in the house, and then you can accelerate more of the depreciation, get the real estate professional, not limit the losses, offset W-2. The other one is the short-term rental. It's the same exact strategy, except the boxes you got to check are different. So the short-term rental loophole, I hate the word loophole, but the short-term rental loophole opens you up to where, okay, I've got a W-2 income. I don't have to hit the 750 hours. I also don't have to spend more than half my time doing it. This is one I haven't done, but you've got to hit 100 hours. If I get this right, you got to hit 100 hours and you have to spend more time than anyone else. So as long as, and the average rental period has to be 7 days or less. So basically, if you've got people coming in your Airbnb and doing 2-week rentals, you're not going to qualify for this. So you got to keep the average rental period. Now you could have one for 10, as long as you got a bunch of other 5s and the average comes down below 7. 7.1 doesn't count. It's got to be 7 or lower. And you got to spend 100 hours managing, working on it, doing it. And you've got to spend more time than anyone else. And so those are your check those boxes. Then you do the cost seg study. You get the big depreciation, get a big loss, and you no longer have to, you can take the loss. It doesn't get limited by the passive activity rules. Because what happens most of the time is most of these folks who can do these things, they're making more than $150,000 a year as a married couple. Man, I think I haven't had anyone single lately who's hit that, but I'm guessing it's half of that. I'm not sure. Don't hold me to that. But get the 150,000 income limit. If you're above that, you get no losses, no passive activity losses unless you have other passive activity income to offset it against. So that real estate professional or short-term rental, the 100-hour more than anyone else, 7 days, that gets you out of that that gets you out of that passive activity piece, and then you can do it. Now, cost seg is going to cost you some money, right? So you got to make sure that you can save enough taxes for this to be worth it. You go buy a $250,000 rental property, probably not worth it. Go buy $1 million Airbnb home, probably worth it. So that's that one. Conservation easement syndication. This is one I probably would just flat out say, don't do it. I had one client do it a couple of years ago, and I told him I wasn't doing the tax return. Another big four, big 5 firm did the partnership return. And so I was like, well, they're clearly okay with it. Why don't you reach out to them and have them do your personal tax return? So no issues really with doing the personal tax return. Okay, conservation easement syndication. This is where you buy into a partnership. You put in a $50,000 investment. Partnership then does a conservation easement on a piece of property it owns, gets it appraised, and somehow, magically, it goes up in value from the time you put the money in to when they do the appraisal. And you put in $50,000 and you end up with a $250,000 charitable contribution from this thing. Clearly, the kind of like logic is going like, how did that happen? Like this kind of magic loophole, right? No, it's not a magic loophole. A lot of times, it's a bogus valuation. So these are listed transactions. A listed transaction with the IRS means you have to tell the IRS you participated in this. So if you think, okay, the IRS is requiring me by law to tell them I participated in something, it's probably a little on the risky side. Now, some of these go through, they're fine. I mean, they've got now 2 different rules around them. But last time I heard, I'm pretty sure those partnerships are getting audited at 100%. 100% of those are getting audited. So think about this, maybe 3 years down the road, that $250,000 deduction comes back off your tax return because they audited it, said it was a bogus thing. Now you don't go to jail or anything, but you're going to pay the taxes. You probably grossly misunderstated your income. So you're going to have a big penalty and you're going to have interest. So I don't find where these things are worth it. Another one, turn your hobby into a business legitimately. And maybe you have a loss in that first year you can deduct. So again, I saw a video, person said, open up a business, create an LLC, charge a friend $100, and now you have a business and you can write off your car and your phone and your home office. And it's like, that's not a business. Like you have to have a profit motive. You don't have to make a profit, but you do have to have a profit motive. So it's like, okay, there's ways to there's criteria and stuff, but if you have a hobby and you can legitimately turn it into a business, probably that first year, you're going to have more expenses than income, but as long as it's legitimate, you can do this. And maybe you get some losses there. Otherwise, hobby losses, you're spending more money than you're making on this hobby. You don't get to deduct them. But again, that one, I mean, to me, the long range plan for any business should be to make money. If you're losing money to save taxes, that is a dumb tax strategy. Because you're losing more cash than you're saving in taxes every year. It's just stupid. I mean, I'd be honest, I'd be direct with people when they ask me. It's dumb. It's the dumbest thing I've ever heard of. Now, again, you turn it into a business, you lose money the first year, get the deduction, and then eventually start making money. Fine. But I'd rather make $5,000 and pay $2,000 in taxes on it and keep $3,000 than lose $5,000, save $2,000 in taxes, and I lost $3,000, right? I mean,
Yep.
at the end of the day, I want more money in my pocket. I really don't care what my
Yes.
tax bill is. I just want more money in my pocket.
Yes.
And making money is going to put more money in my pocket than losing money.
Absolutely.
That's why I put it there. Oil and gas investments. I mean, I've seen these. I don't have any clients that have done them. I don't know a lot about them. I just see people talking about them. But this is another one of those things where, you can invest money in some sort of public entity. You probably, or maybe it's not public, but you get a K-1 from it. It's a partnership you're a part of. There's losses there. I think there's like specific types of it's either amortization or depreciation on this stuff. And it can create paper losses, so they say, so you're not actually losing any money. I don't know what the flip side of that investment is, if it ever actually makes any money and you actually have a good investment. That part, I don't know. So I haven't done these, but some people do them. And then my last one, most people aren't willing to do it, but it could be the biggest tax savings you ever make, and that's to move to a no-income state. You can come join me down in Florida. Instead of paying 5.5% North Carolina state income tax, you can pay 0 down here in Florida. Now, most people will say, yeah, but your property taxes are higher and your sales tax is higher. Well, our sales tax is about the same as North Carolina. Our property taxes are about the same as North Carolina because all the tourists who come to Florida pay for the toll roads and the hotel occupancy tax and pay for everything. So that keeps most of that stuff in line with other places with no state income tax. So moving to a no income state tax, seriously, could be a huge tax benefit for some people.
Absolutely.
But that's everything I had under the planning opportunities. I don't know if I missed anything that you've thought of or had questions about, but I mean, that covers most of your low-hanging fruit, middle-hanging fruit, and then the stuff that I honestly, personally wouldn't even touch myself.
And so I really appreciate, and this is why I wanted to have a conversation with you specifically, your approach of, okay, let's think full life, big picture. How does all of this fit in? Don't just minimize for this year.
Yeah.
Hopefully you have a year after this, and hopefully you have a year after that, and so on and so on.
Yeah.
So,
I mean, the car's a perfect example too, because everyone likes that. Because who doesn't want a new car, right? And if I can
right.
save taxes, then it makes getting a new car worth it. Well, not necessarily. Do you need a car? Not really. Okay, well, there's number one. Don't go buy a car because you don't really need one, right? Okay, number two, how much do you plan on using the car for business? I don't know, probably 30%. Okay, well, we're only going to be able to write off 30%. There's not like this, like you can write the whole car off. You still got to pay attention to how much the business use of the car is. And so, if you're not going to be able to do that, we can only write off 30%. And then again, it's the discount, right? You're not saving any money. You're getting a discount on the car. And then, you're still out of pocket all that other money. So
absolutely.
The car is a big one.
Yeah. Great point about that.
Again, this video was part of a longer interview video that we had, and I will post links to the other segments as well as the full video in the description below, and you can check those out as well. But I hope that this was helpful, and I hope that it helps bring you peace of mind when it comes to your tax and financial responsibilities. Thanks for watching.